I'm speaking with Morgan's Chief Economist Michael Knox. Michael, thanks for your time.
Thank you, Tom.
It's a fascinating market for investors. On one hand, you've got the US market at all-time highs, volatility is at very abnormal lows, China's transitioning. I'm going to ask you today about three key parts of the market for investors, namely the US, the Aussie dollar and markets in general. If we start on the US, Trump's reforms are in the pipeline. They may or may not come through around tax reform. There are other issues with healthcare and interest rates rising in the US. What's your outlook on the economy for the US in general, and should we expect this momentum to continue?
Well, the US economy this year started off pretty slowly, at less than 2% growth in the first quarter, but it's accelerating as we're going through the year. So the Atlanta Fed, nowcast, which is the most accurate estimate we've got for third quarter GDP, says that growth should be 2.7%. So we think that growth for the full year should be about 2.4%, which is around about long-term trend. Long-term trend's probably about 2.45%. And that's supporting continuing earnings growth in the US, and that's supporting a stronger stock market. The real question is next year. We think that the economy will accelerate to 2.7% because we think with very low levels of unemployment. I mean, unemployment in the US is now 4.2%. That's the lowest level since the very beginning of this century. And we think at that level, what we'll see is wages growth, and that wages growth will generate more levels of capital investment in the US economy. And that growth in capital investment will generate the acceleration of growth next year to 2.7%, which will mean even higher earnings. The Federal Reserve, on the other hand, thinks that next year the US economy will slow down. They will have been successful in tightening rates this year and slowing the economy next year and making sure unemployment doesn't go, say, below 4%. So that's an open question, and that will have a major impact on markets as we get into next year.
Sure. If the US is going to continue its steady recovery and re-acceleration, should that not exert downward pressure on the Australian dollar?
Well, the Australian dollar is really driven by the difference. We've said in presentations before about the Aussie dollar that it's really the volume of US debt that's out there in comparison to the volume of Aussie debt that's out there. And the big thing that swings that around is the US budget deficit. And the US budget deficit right now, according to both the Congressional Budget Office and the International Monetary Fund, has a pretty flat outlook. Now, they've got different numbers for what that flat outlook means. The IMF number is a high number because it includes all of the things like Social Security and healthcare payments and state governments as well. But it's still pretty much flat. And in that circumstance, and the Australian budget deficit is still pretty much flat. It's improving a bit. We occasionally have good news, but the movement isn't that great. So with that relatively flat outlook for budget deficits, the long-term trend for the Aussie dollar is flat. And we think that the midpoint of that flat range is 75.5 cents. But our model has a standard error of about 6 cents. So that means the Aussie dollar can swing, up to 80 cents and a touch above, or down to 70 cents, say. It's going sideways. But there's something else happening at the same time, and that is that the euro area is recovering. Euro area is doing the best it has, since the financial crisis. And that's drawing capital into the euro area, and that's forcing the euro up. Now, we think that the euro, which is trading currently at about 1.18, is really worth about $1.30. Okay, so we think there's considerable upside in the euro over the next year and a half. The euro is the biggest weight in all of the international indexes of against which the US dollar is traded. So as the euro goes up, the US dollar is going to go down, And that's going to, in the short term, push up the level of the Aussie dollar. So that's why we've been pushing up at 80 cents in the short term. But what we think is going to happen is that the Aussie dollar already has this year, honestly. It will fall against the euro it really has since February, fallen significantly against the euro. And we think it'll do that the same again next year. So you've got these, what appears to be a recovery in the Aussie dollar, and then it comes off to mid-range. So we'll see this continuous range trading as international currencies adjust. The euro adjusts to a new high and a rising trend, whereas the Aussie dollar adjust to a downward trend against the euro, which means on balance we go sideways, but hey, there's a lot of price action on the way.
Sure. And the question on every investor's minds, particularly around the US, is the US recovery priced in the US share market? And what's your opinion on valuations in Australian shares?
I think something completely different is happening in the US. Yes, the recovery is priced in. That's absolutely the case. We've said that where US stocks are trading, the S&P 500, is where fair value is in a year's time. So it's entirely anticipating the improvement in growth. But there's something else happening again. When you get to the last couple of years of stock market boom, that's the stock market tends to generate its own liquidity. And how that happens and how you can gauge that is in terms of the market for corporate debt. We actually saw this happening, same thing happening about 2006 that we're seeing now. That is to say, you're seeing a significant decline in the yield on US corporate debt relative to sovereign debt. And when that happens, as it's happening now, and it's driven by better and better earnings, and so people want to buy this corporate debt, then that makes stocks more attractive relative to corporate debt. And that generates liquidity to the equities market, and that continues to drive the market up. So we're seeing this liquidity coming into the US equities market, and it's that additional liquidity which is driving the market up. Now, that'll go on as long as earnings continue to rise and add liquidity to the markets, and as long as that bond differential continues to narrow as it did in 2005 and 2006. Now, all these things will come to an end, but we'll have to cover that sometime next year when we see that trend occurring.
Sounds like US economy up, Australian dollar flat to down, bull market has further legs to run, but be careful.
Yes, but there's one other thing I'd like to add, Tom, and that is that our market is now entering a positive phase itself. Our market has been disappointing, since between April this year and October this year. And there's a couple of reasons for that. We actually overshot at the beginning of the year. Our market ran up with the Trump bump ahead of the improvement in fundamentals in Australian equities. Now, as we've come through the year, we are seeing that improvement in operating earnings per share, and we've also seen a situation where the sell-off in bonds that we saw early in the year is now seems to have stalled. So our bond yields are still low and our earnings are going up, and therefore we have upgraded our estimate for fair value for the ASX 200 just in the last couple of days to just under 6,100 points. And that means that even though we've had a rally in the last week, there's still significant upside in the Australian market for equities over the next 6 months.
Terrific, Michael. As always, there's a lot in there for investors. Thanks for your time.
Thank you, Tom.